and welcome. You're watching Closing Trades on ET Now. I'm Anisha Jain. With me is Aisha Faridi. And the momentum that we were seeing in the market has completely fizzled out at the moment. We're below the mark of 17,100. So a bit of a U-turn from that 17,200 mark. And that has definitely become a bit of a resistance zone because we have not been able to come out of the range of 6,900 to 17,200 that we have been stuck into. And today as well, we have made a U-turn from that level. Today, of course, is the weekly options expiry, so the added volatility is there on account of that. But separately, the broader markets are also underperforming today. So the mid-cap index, small-cap index are under pressure, and the market breadth too is not looking very impressive. In fact, it is favoring the declines as we speak. And the Bank Nifty is also underperforming. There's a cut of almost 200 points coming in from the Bank Nifty. So a sharp fall from the highest point of the trading session. Separately, it's the IT counters which are on the back foot at the moment. Remember, Nifty IT has actually been at a 5-month low now, and that is ahead of the numbers coming in from Accenture, wherein a large part of the street believes that there might be a guidance cut coming in from Accenture. So that is something that is putting pressure on the IT stocks. Having said that, at least FMCG stocks are holding up in the green. The palm oil prices have corrected as much as 9% in the week gone by itself, and that is something which is supporting the momentum at this point of time. And even globally, Aisha, not much cues coming in after that big fall yesterday after the Fed meeting. For now, futures are a bit sideways.
Yeah, they are sideways. In fact, I mean, to think of it, given how the handover was from US equities, I would say we have actually been the region outperformers, or global outperformers, so to speak. Yes, you are seeing the markets now drift down and challenging that 17,100 level. But let's see how we go. Because even for the European markets, the picture is no better. They're at best flat with a bit of a negative bias. In fact, FTSE is down about almost 0.5% there. And like Anisha was just pointing out, even for US equity futures, after that near about 500 or 550 point fall that the Dow had overnight, it's only making a move of 0.5% right now. That's the Dow futures, and similar is the price action for both S&P as well as the Nasdaq futures as well. So yes, even though the Fed event is out of the way, you're not really seeing any relief come by way of equity markets. HAL, of course, after that OFS announcement, that's been taking a pounding. That's down about 5.5%. Vedanta, even though the company has managed to issue, a denial that they are not looking at, selling any stake, the stock is still lower by about 4.5%. Berger Paints, Indibles Housing, Page Industries, these are a couple of laggards. And, sporadically, couple of banks, financials, Bandhan, Manappuram, both of them are looking good. Hindalco is holding up 1.5%, and Berhampur Chini is sitting right on top there. 3.5% higher at 377 odd levels. Good time then to bring on board our experts and find out what they're making of the trading day so far. We have Pankaj Murarka to talk about the fundamentals, Kunal Naresh on the charts as always. Gentlemen, hi, afternoon. Kunal, firstly to you, because it started off looking okay. We were almost, around that 17,200 print intraday, and then now again beginning to cool it off.
Good afternoon, Aisha. So, I think my sense was that the indices were, going to be a bit more range bound today, and I think we've managed to just about trade in a 100 point, 150 point band for the Bank Nifty so far, a 50 point band plus or minus at 17,100 mark throughout the day. So it doesn't come as a surprise that the action is limited towards the stock specific, and I think today's majority of the price action, at least in terms of the open interest, what I can see is majorly on the bent of the open interest trends. And that is because of the weekly expiry. So no major trends emerging for the Bank Nifty, but it's just that we've not corrected as sharply as compared to the handover from the US markets. That's the only positives which you can take away from the closing play.
Okay, Naresh, what about you? What are you making of the texture of the market at the moment? A sudden slip, and 17,200 seems to be a tough resistance area for us now.
Yeah, so we continue to stick into that range. Say 16,800 has held on the lower end. 17,200 is where the pivot point is. If we start closing above it, it opens up a move towards 17,600. The event is out of the way. There's a little bit of a jitter, but the main index which I look out for is suggesting a risk-on move is the dollar index. That broke yesterday's low also today. It is getting back to that 101, 102 zone, which was the recent lows. If that breaks off, we get a risk-on environment across the globe. So overall, playing for a bullish move over the next 2-3 weeks would keep a stop loss at 16,800 and continue to be long.
Pankaj, hi, afternoon. What do you do in this kind of arranged market? Is it time to buy? Is the worst behind us? You obviously can't time it to the T, but are the valuations looking comfortable?
Hi, Aisha. What you should be doing and everyone should be doing in Indian equity markets at all points of time is just keep buying good quality companies and never sell them ever. Coming to on a more near-term point of view, I think valuations are actually moderated now because after this correction, if you look at Indian valuations, we are at about 17 times 1 year forward earnings. This is actually pretty much in line with last 15-year averages where Indian markets have traded. So I think, given that the mayhem that is played out globally and some nervousness around this bank failures in US and stuff like that, obviously valuations in India, I think, have become very reasonable or attractive for a longer term investor. So I think, and the fact that markets are around these levels, I would like to think about it is this is a healthy consolidation that's playing out in the market. And this is really a good time to invest for investors taking a slightly more medium term to longer term view.
So that's the advice at this point of time on the equity markets. But specifically, Pankaj, I also wanted your take regarding the IT stocks because they continue to reel under pressure. There was a bit of a hint of a recovery at the start of the year, but that too has fizzled out. And now with the BFSI sector coming under pressure, plus the expectations from Accenture being a tad bit muted, how do you think one should play the IT stocks? Buy for long term or at least wait it out? There'll be better levels coming?
I think if you look at the sector has underperformed over the last 18 months, and during that period, earnings have grown, which effectively means valuations in the sector across the board have moderated by 20 to 30% than where they were 18 months back. I think valuations have become far more reasonable. There are short-term concerns on growth outlook given some of these bank failures in US. But the fact is that these smaller banks, regional banks, are a very small proportion of business for Indian IT companies. So unless you make out a case that US goes into a very deep recession and global economy goes to a complete very deep recession and a big crisis, which is not my or even the consensus based case, I don't think so. There's a meaningful impact on IT companies and they'll still deliver growth. Short-term quarterly volatilities in terms of growth might still happen, but the fact remains that globally, if you talk to the top 500 companies, one thing which is very strategic now on the CEO's agenda of all the Fortune 500 companies is to digitize their business, which effectively means more digital spending. I think it's a good time to accumulate these IT stocks, probably over the next few months, and take a 2 to 3 year view. And I think investors with medium-term time horizon can really make healthy returns out of the sector because the growth outlook for the sector remains very much intact.
We can't let you stop at that. You've got to give us the top 3 pecking order as well.
Well, meaning I would say investors should begin with large caps. Within large caps, obviously, we have ownership across Infosys and HCL Tech because both of them are delivering the highest growth within the industry. And we also have ownership in Tech Mahindra now because there we see a delta change in terms of a new CEO coming in. And in IT companies, we've essentially seen that when you have a CEO change and if the incumbent or the incoming CEO has a great track record, he can really drive very strong growth. So Tech Mahindra as such has been underperforming industry growth for the last few years, but we think they have a very credible guy coming in as a CEO probably sometime in July, and he can really drive a lot of changes in Tech Mahindra by virtue of which we would expect that their growth potentially could be much higher over the medium term versus what historically it has been. So I think to begin with, investors should start with large cap IT names. And probably some point of time during the middle of the year, once we get a better clarity on outlook for US growth, probably enable into some mid-cap ITs as well.
So that's a take coming in on the top IT bets as well as how you should play the large cap names. But let's also look at some of the other counters which are buzzing in the trading session. It's Spark, which is up around 11%. Sun Pharma Advanced Research Company, which is up 11%. GR Infra Projects has been bagging a lot of orders today as well. There was an announcement of 13 crore order. So that stock too is holding up with a gain of around 7%. So let's watch out for that also. And in fact, on price volume action, let's look at some of the other names as well, which are buzzing on account of that, because there are a whole host of names like Berger Paints as well, which has snapped the 6-week streak of forming higher lows. There has been a breakdown from the 5-session consolidation and it slipped below the 100-day moving average. Remember, today there was a note from on Asian Paints as well, wherein they talked about that how every rally should be used as a selling opportunity, and that's perhaps having a rub-off impact. Page Industries too has formed a bearish belt hold candlestick pattern, snapped 6-session streak of forming higher lows, and the trend is reversing from the 50-day moving average as well. Kunal, your take, Berger Paints, Asian Paints, the other paint companies, would you like to make a trade there?
So I think the trade would be on the upside, but I'll still wait for maybe a day of confirmation of a breakout back again, because Asian Paints, for example, the stock which showed good recovery, I think in the last couple of trading sessions, tried to come back towards 2,850 or 880 odd mark, which was just marginally below the 200-day moving average for Asian Paints. But today the stock has seen a corrective phase back again. So I'll wait out for the confirmation that when Asian Paints breaks past about the 2850, 2880 mark, that could be a zone where would look to buy. Same would be the case with Berger Paints. I think that stock made a high of 605 or 610 last week or so. So I think that would remain to a breakout point. So only on the breakout of these two levels is where I would believe that a trade could be initiated into these stocks.
Right, okay, let's get some closing ideas as well. Naresh, on your list?
So being a little defensive, going into NTPC, which has corrected a bit in the last few days from 180 levels to 174, looks like a place where it should bounce back from, back to 180 out in this one.
Right. Kunal, what about your strategies?
So that will be ITC. That stock has been looking very attractive. In fact, just last couple of trading sessions back at 370 levels, initiated a buy in ITC. Still remains to be a buy at 380 plus levels.
It's a closing trade coming in from Kunal as well. What other things are buzzing around? So Vedanta is definitely something which is down 4%. Pankaj, do you see any kind of sense in that report which suggests that the promoter might be looking at selling some stake to pare down the debt? Do you think any possibility of that happening? Would it be a prudent strategy just to cut down the debt?
Well, Manisha, honestly speaking, I don't have a view. We don't look at this company very closely, and generally we tend to avoid commodity companies because of high volatility in commodity prices. And this is one name in which I have personally not invested for a very long time. So I don't have a view there exactly in terms of how this plays out. But I think companies where leverage are high will have to, given the concerns around leverage with some of these Indian companies and many companies globally, will have to take appropriate actions to moderate or manage their leverage.
Okay, Anisha, just the other day we spoke with Nilesh Shah from Envision Capital, and here's what he has to say about not just IT but various other sectors where he believes one can start buying in right now.
So I don't think it's going to be worse than global markets. It probably could be that India would fall or correct or consolidate in line with global markets. And then after that, I think come the end of this year, the start of next year, 2024, you're going to see a huge outperformance coming in from India, because again, all the positives will come back, the world gets into a risk-on trade, and India is going to be the dark horse.
Okay, so let's divide the market in three time phases: 1 year, 3 year, 3 year plus. What looks good and attractive for 1 year, 3 year, and 5 years?
I think because from a 1 year perspective, the large caps look good.
Okay.
I clearly believe the
Buy the Nifty.
Buy the Nifty, or buy a basket of maybe 5 to 6 stocks in the Nifty, and I think they all have come off on an average by about 25%, 20 to 30% from their peaks. Maybe the room for them to fall further could be 5 to 10%, because you can never say where the bottom is. But I think from a 1 year perspective, I think that pack will do extremely well. Okay, so I think from a 1 year perspective, I think that's the space. From a 3 year plus perspective, I clearly believe that the mid caps and small caps will essentially are going to beat every asset class globally and in India hands down. Okay. So I clearly believe from a 3 year plus horizon, I think mid to small caps look really well poised for a big outperformance.
5 year plus?
Hard to say, but I think 5 year plus, I clearly believe that in a bull market or an upcycle, the mid and the small caps will outperform. And this has happened always. And so if you ask me from a 5 year plus, again, it's going to be largely mid and small caps, which will do extremely better. Now you could, when I say mid and small caps, it could also mean a bunch of stocks which today are probably hated, are large enough, but you can't call them as mid and small caps because the capitalization is a bit higher. But for example, some of the stocks on the online side, which had IPO'd in 21, I think from 5 years from now, these could be hugely profitable companies and they could be a lot more valuable than where they are today. So it could be a set of stocks which are either hated today or are doing well but are still mid and small caps. So from a 5-year perspective, I think that's the pack which will do very well.
And here's Motilal Oswal, by the way. They've maintained a buy on Craftsman Automation after it acquired that 76% stake in DR Axion against a consideration of 375 crore rupees. Let me take it across to Vamakshi and find out what Motilal finds interesting about Craftsman.
Well, recently we did see that Craftsman Automation acquired a 76% stake in DR Axion India Private Limited, and that was against a cash consideration of 375 crores. Now, Motilal Oswal has come out with a note on the same. They've maintained a buy rating for Craftsman Automation and given a target price of 3,925 per share. Now, DR Axion is a manufacturer of aluminium cylinder heads and blocks for PV OEMs. Now, they currently supply
Akshay and get an understanding as to what's happening with Craftsman Automation. But in the meantime, let's slip into a very short break. We're below the mark of 17,100, very close to the session lows as well. And let's see what's really plaguing the market at this point of time. Is it the Bank Nifty? Yes, that's also putting quite a bit of underperformance today. It's down almost 200 points. So a cut of almost, 1,000 points coming in from the highest point? No, 500 points from the highest point of the trading session. Bank of Baroda, PNB, SBI, these are your key lagouts in the trading session.
Okay, drifting a little bit even further, we're now down almost 0.4%, so clearly given up that 17,100 mark. Banks, they're the ones which seem to be the culprits right now, with the Nifty Bank underperforming. Almost 0.7% is the kind of loss that you're seeing right now for the Nifty Bank. In fact, some of the big boys as well. Look at an SBI, for instance, and the kind of pressure that's seeing. ICICI Bank also has now turned tide, and that's beginning to flatten out. IndusInd Bank, HDFC Bank, they're all in the red. Kotak is down 1% as we speak. Anisha highlighted a BOB. That as well is a big drag. In fact, the biggest loser from within the banking pack, down 2.25%. IDFC First, Federal Bank, SBI, Axis, AU Bank, they're all in the red. It's only Bandhan which is holding up 1.25%. Pankaj, what do you do with banks? Because as varied as the sector may be, but do you think for the interim at least it's best avoided?
No, I actually not, because Indian banks are in a very fine shape. After a very long time, we've seen strong credit growth in the sector as a whole because of the revival of investment cycle from the private side. We are in a rising rate environment, which effectively means banks tend to have pricing power in this kind of environment because demand for funds is strong, and which is why they tend to enjoy strong margins. More importantly, asset quality of the banks at this point of time across the board is probably the best that we've seen after 2000, after the financial crisis in the last 15 years, where we know that they don't have any legacy bad assets or they're not hiding under anything in their balance sheets. And in case any asset goes bad, we have a regulatory tool now in terms of IBC to deal with it, which was not there until 2014-15. When the regulations came into place. And more importantly, valuations of banks are reasonable, fairly reasonable in the context of the growth that they're going to deliver. So I think for an investor willing to take a medium-term view, banks makes a very attractive investment bet. And as I said, after a very long time, I'm seeing the sector as a whole tick all the boxes in terms of asset quality, growth, margin, and valuation, because all of those don't happen at the same point of time. Some point of time we get valuations right, but there are concerns on asset quality, or there are concerns that margins might moderate. But at this time around, none of those concerns are there. So maybe these stocks have corrected because of this global nervousness on banks as a whole. But I think Indian banks are very different than some of these global banks in that sense, and Indian banks are completely immune to those global exogenous shock to the banking sector. So I think investors should take a slightly more medium-term view, and for them, banks make a compelling investment.
I meant to ask was, I mean, banks, of course, are part of everyone's portfolio, whether right now should be a good time to add a fresh or not. Kunal, what do you think? You think one should be buying banks right now? Any of them?
Well, yeah, I think PSU banks could be a better bet at current levels, I believe, because most of the PSU banking stocks have actually corrected by more than, I think, 20%, 30%, depending on which market cap, etc. you're looking out for. But then I think broadly 25 to 30% is what the PSU banking stocks have gone into a corrective phase. And remember that in the last, I think, 2022 second half, it was the PSU banking sector which actually was one of the best performing sectors, which did exceptionally well. So from the rise towards the correction, I think it's a classical mean retracement which has been completed for the PSU banking stocks. So if there's one sector which I would be bullish on from the banking space, that would be PSU banking stocks. From the private sector names, I think the latest ones which have actually shown signs of a decent recovery would still be the likes of maybe Federal Bank from the mid-cap space, and even ICICI Bank from the recent charts have shown some decent recovery. These stocks have not participated on the way down in the last 3-4 months, by the same extent. And often off late, the last couple of weeks, these stocks have shown a lot more stability as well as durability. So these would be the few names which I'll be picking out for.
Okay, so that's the take coming in as far as the banking index is concerned. Today, of course, the volatility is also on account of the weekly options expiry, and then there's going to be an early monthly options expiry come next week, because Wednesday is the day when we'll have the options expiry. In fact, one more thing that will play out for this monthly options expiry is the latest announcement coming in from National Stock Exchange, wherein they have decided to withdraw the do not exercise facility for investors trading in the stock options segment from March 30th. Brokers said that the move could result in traders incurring unprecedented losses on the expiry day of the futures and options contracts. Ankur Mishra, my colleague, is joining in with an explainer.
Yes, National Stock Exchange has scrapped the facility of do not exercise which was available for traders till now. Remember, in 2019, SEBI had introduced physical settlement for all the derivative contracts upon expiry, and after that a do not exercise facility was available for traders. It was lapsed earlier also, but it was reintroduced in the April month, and due to that many of the traders can exercise that option of not necessarily converting their derivative contracts into delivery and cuffing up margins due to that. Now that facility is not available, many of the traders suspect that they might incur losses and also cuff up more margins for conversion of their options into actual physical delivery. The problem is especially with the in-the-money options, if at all it happens on the expiry day, because a trader might have taken position based on the little movement in the options premium, but if the stock is illiquid and there is no buyer available on that day, upon the auction in 2 to 3 days, the settlement may happen, and for that one there is more margin, and also he might incur losses if at all it happens after 1 or 2 days. So that is one of the concerns which has been raised by the traders. But the idea of SEBI is that we understand is to discourage too much options trading, which has been growing leaps and bounds, and also to regulate properly so that the conversion of those derivative contracts happen in form of delivery.
Okay, Hindustan Aeronautics, that stock continues to be under pressure after the government has launched its OFS. They're looking to sell about a maximum of 3.5% stake at a floor price of 24.50. The stock currently at 24.96 thereabouts is where it is currently at. So that, of course, has been one key pressure point from the word go. Vedanta, even though the clarification came in from the management that they're not looking at any stake sale, continues to be bogged down, still down 4.5%. But on the flip side, Balrampur Chini, Coromandel International, Manappuram, Hindalco, Biocon, it's an interesting mix of movers out there. Can't really draw out a trend or anything, but they continue to hold out, as does a Maruti, a Bharti, or for that matter, even an ITC, which has now climbed up all the way to almost touching 381 as we speak intraday today. Nestle, SBI Live, these are a couple of other names which are actually holding out. Pankaj, before we let you go, let's have the top 3 house buy calls from you.
Of late, Aisha, I've had a new fantasy in stock market, and which is internet companies. So
Off late, I thought you had that since the COVID time back in 2020.
yeah, so my infatuation for those companies has only increased over the years because as I see my own lifestyle and lifestyle of people around me, I realize that as consumers, all of us are getting more and more digital in every single bit in our daily life. And if that's the way, then I think these digital businesses have a very long runway of growth. There's a very startling statistics I can share with you. You look at this, NASCOM has just predicted that by 2030, India's IT services exports will be about $500 billion. Our view is that internet companies in India's internet economy will be more than $500 billion by 2030. And IT, if you look at the IT services sector, the total market cap of the sector is about $350 billion, and the market cap of internet sector is just about $35 billion. Obviously, a lot of companies are unlisted, which will get listed over the next few years. But I think there's a huge opportunity there in terms of wealth creation in the internet sector. So I like that sector as a whole. Having said that, investors should do their due diligence before picking up stocks. But obviously, we own few stocks there, and we always looking to increase our exposure there on the right company at the right prices. So that's one segment or sector which I like phenomenally well. And apart from that, we are turning positive on healthcare as a sector because that's a sector which has not performed over the last 2.5 years. More importantly, they had significant earnings downgrade or earnings degrowth over the last 2 years because of pricing pressure in US market. We think that's moderating, and next year onward, the sector as a whole and most of the companies will start delivering strong earnings growth out there. And and because of the underperformance over the last 2.5 years, valuations in the sector are far more reasonable. So that's another sector which we have started liking and we're looking to add incrementally to our portfolio. And apart from that, we continue to remain positive on capital goods as a sector because we think the underlying trend in terms of private sector capex remains very strong, and most of these companies continue to record high teens kind of a growth in the order book. So they'll continue to deliver strong numbers because there is very strong visibility because of the order book that these companies are having. So that's another sector that we like.
Getting attracted to capital goods and healthcare, and the romance really continues with this new age tech companies and internet companies. But Pankaj, tell us which are the ones that you like the most when it comes to new age tech, because it's very, very company specific, right? Zomato, Paytm, Nykaa, PB Fintech. Which is the one you like the most?
So I would like to make a disclosure. We own Paytm and Zomato in this space, but I must also say that some of the other companies, we like their business models. Maybe we haven't bought in them as yet because of our concerns around valuations, and maybe at a more appropriate entry point, we are looking to buy into them as well. More importantly, I believe over a period of time, the universe of these companies will expand significantly. And I'm saying this because I'm drawing from my experience as an IT analyst in mid-90s and late 90s when we had a handful of IT companies, and then all of a sudden we had, during late 90s, so many of these IT companies get IPO'd and the universe expanded big time. I think something similar will happen in this internet space over the next few years because a lot of these companies which are private today will get public sooner or later as they grow their business. And I think that universe will expand significantly.
Thank you, Pankaj, for joining us with that take on which are the stocks and sectors that you like at this point of time. In fact, on that note, we'll slip into a very short break as well with the news that there's no buying on dips which is emerged at the moment. Yes, there seems to be a bit of a flaw, but we need to track that very closely. Of course, SBI is down almost 1.5%. You also have HDFC, which is under pressure, PNB, Bank of Baroda, IDFC First Bank. These are some of the other names from the banking index, which is taking it on the chin at the moment. And it's only Bandhan Bank that is actually managing to hold on in the green with a gain of almost 0.6%, and maybe Indian Bank, Central Bank to name other few, because rest of them are actually deep in the red territory. Good time then to get on board Mahantesh Sabrat. Mahantesh, you've looked at the banking sector closely for the longest time. Where do you think we are in the cycle, and does it merit a bit of a relook, or do you think that consensus buy trade will continue to work?
I think the consensus buy trade will continue to work. We are simply seeing the pressure on the banking stocks coming out of the FII kind of selling, not really anything to do with the domestic issues. So we are nearing the end of the rate hike cycle. So from a bank's perspective, what is really happening is while the interest rates were rising, they had enjoyed a bit of NIM expansion. Now there would be little bit of NIM contraction, but the business volume is likely to grow quite substantially. So between the trade-off of the NIM versus the overall business expansion, we are already seeing the credit expanding in double digits, upwards of 12-14%. Some of the banks are actually growing at 18% in terms of their advances growth. So the trade-off between advances growth versus the NIM compression will still be working out favorable for most of the banks. And since we are nearing the end of the rate hike cycle, I believe that much of the pressure for the banks will start easing henceforth.
Names that you think stand to gain the maximum, or they will be able to make, tap into the opportunity in the best way?
I think the pressure for the banks now will not be there. Therefore, the opportunity they will be able to tap into is going to be quite large. Let's look at it this way: most of these banks are well capitalized.
Sure, no, Mahantesh, my question was which stocks will be able to best capitalize that opportunity and tap into that?
Yeah, so I was coming to that.
Sure.
So you have to look at from the point of view of the capitalization of the banks. Most of the banks are well capitalized. That means the requirement for additional capital to henceforth grow is limited. That if you were to distinguish between the banks, then the set of private banks, particularly the small private banks, will be constrained in terms of growth ahead because their capital needs will be excessive relative to some of the other banks, and some of the PSU banks obviously will be in need of capital. The larger private sector banks will not require capital henceforth for growth. So my reckoning is if you take the top 3-4 banks on the private side, they should be able to better capitalize the growth opportunity ahead.
Just looking at the list of gainers today, and while of course ITC, Nestle are doing their bit, ITC in fact is holding up almost 1%. Maruti as well has had a strong session today. 83.64 is where that stock is, and Tata Motors as well has been quite resilient, so to speak. Kunal, we've been talking about the auto space for a while right now, and you've always had a bullish stance on Tata Motors, Maruti. Today's resilience aside, you think even at these levels they can be bought?
Well, they can be bought, they can be accumulated as such. I would not go for a heavy quantity buying over here because the market itself is a bit more directionless as well as trendless. So in that regards, it's just that these stocks have been a tad bit outperformers over the last couple of days. That makes the short-term outlook into these stocks a lot more positive. Now, in terms of the breakout point, the two breakout points which I've been highlighting time and again for the stocks, for example, Tata Motors 450 is a massive breakout point for the stock price because that's where the stock has taken a huge resistance over the last 6 to 8 months. So whenever the stock breaks past about the 450 levels and confirms a closing about those levels, that's where I believe a longer-term trend could emerge to be much more positive for Tata Motors. Till then, we can expect that this 50-point, 60-point trading which the stock has been going through, that will probably continue. Same would be the case with Maruti. I think 9,000, 8,850 to be precise, important levels of resistance for Maruti. And on the downside, 7,850, 8,000 has been a crucial support. In fact, I think last couple of days back, the stock formed a bullish candlestick pattern, and on the back of it, you're seeing some bit of recovery for the stock price. So I'll still expect that this is a recovery in process rather than any kind of a meaningful change of trend for both of these names. So for traders who are looking at a short-term outlook, can look to participate, but from a long-term play, it's always better to buy when these stocks confirm a big breakout for themselves.
That was about a couple of auto names, but as we are flagging out, the likes of ITC are also doing quite well. And just a few minutes ago, we got commentary from the CMD, Mr. Puri, as well, wherein he talked about that worst of inflation is behind us. He said that rural recovery is likely to do much better than the demand coming in from the urban India in this summer, and exports remains a key monitorable for them in the coming months because of the global conditions. But they are expecting that farmers' income are likely to improve going forward, and that should augur well for the rural economy. And the most important comment for me is the fact that worst of inflation is behind, so that margin pressure that the entire sector was dealing with is clearly away. Mahantesh, your take as far as the entire FMCG pack is concerned, and specifically if you have a view on ITC?
So firstly on the FMCG pack, I do agree that the inflation is on the mend, and therefore a lot of things become quite easy for the FMCG companies, particularly on the margin side. Their own cost of purchases will be down. But recovery in terms of volume growth is something which is going to be very difficult, I would reckon, because you still do not have a proper grip on the crop yield. We have weathers playing spoil sport recently, and that should dip the overall food grain production and can affect potentially the rural demand. Coming to the second part, which is on the ITC side, I think the stock has run up quite substantially. Not really a great fan of ITC per se, but having seen a huge run up into the stock, I believe that that there is nothing much to look forward to.
One of the segments for ITC which has been doing well is the hotels, right? And that is one thing, hospitality as a segment, which has been seeing quite a bit of turnaround after that entire COVID hit came into the picture. There has been a very, very sharp turnaround in terms of the operating leverage coming to the forefront as well. Mahantesh, your take as to which stocks are the best plays in that category, Lemon Tree, Chalet, Indian hotels?
So hospitality is doing really well. You started by talking about ITC first. For ITC, hospitality is really a very small pie of the overall business. It's hardly in single digits. Having said that, for pure play hospitality industry companies, the growth ahead is going to be quite substantially good, coming especially of the COVID lows. So I would reckon that again here you should better focus on the large cap kind of hospitality names, particularly in Indian hotels is the one to go forward to. Since we're talking about the hospitality industry, we should also not forget that something similar is going to brush off on the real estate companies as well, because we are going to see the upper end of the demand actually shaping up really well compared to the overall demand for real estate. Same is the case with hospitality. It is the upper end, which is, or the niche end, which is likely to do better relative to the lower mid or lower market. So therefore, I would reckon some of the larger cap stock names can do well. But for an investor, the choices are very limited, and from a portfolio perspective, really taking an overexposure on the hospitality industry is really not the solution right now.
Okay, Mahantesh, stay with us. Indigo, that held its first ever analyst meet today, and physical analyst meet, that is. So let me take it across to Somit and find out what the key takeaways so far have been. Somit?
The first ever physical meet of Indigo, and what we have understood so far, what the management has been saying in the meeting is the fact that the Q4 demand has been pretty much strong, but the yields are on the lower side. Now this could be also because of the seasonal factor. Usually Q4 sequentially we have seen the yields declining, and that's what the management is suggesting. Along with this, they're saying that the fleet size target for the end of FY24 is nearly 350, and they're saying that FY23 they would end the fleet by around 306, which means that they're planning to add around 44 aircraft, additional 44 aircraft in FY24. Currently, their as of December, their fleet size stood at 301. Now, for passenger growth, they are saying that they are expecting to serve nearly 100 million passengers in financial year FY24 as the next financial year, and for FY23, they're expecting the passenger number to be around 85 million, which is a growth of around 15% and they're also saying that going forward, also the growth would be not northwards of mid-teens. Now, on destination front, that is the network addition front, they're expecting to add around 10 to 15 more destinations in FY24, which will take the total destinations to around 115. And they're also saying that there are a lot of external variables that are impacting their operations, which include the volatility in fuel prices, foreign exchange movement, global supply chain disruption, because of which the plane deliveries are getting late, and also there is inflationary cost pressure that has been impacting Indigo's operation. The street still would want to know some clarity on what is the international growth strategy going forward. So far, the management has not spoken anything on that, so that would be one of the key things to watch out for from the remaining of the Indigo analyst meet today.
Okay, thank you, Somit, and we trust you to get us more details as and when they come from that analyst meet, which is still currently underway. But Nuresh, I wanted your take regarding some of these infrastructure companies. It's the end of the financial year, and usually we see an inflow of orders, and that's been happening for the likes of HG Infrastructure, GR Infrastructure. Both of those counters are quite excited today. NCC, for instance, has hit a fresh 52-week high. I know you're quite bullish on L&T, but if you had to take any other bet in the infrastructure space, what would that be?
I've recommended before. HG Infra is another stock which I continue to like. The technical structure is positive for both of them. HG Infra is close to a new 52-week high and an all-time high. NCC has hit a multi-year high, also above that 100 mark very recently. And the stock is now setting up for a much bigger move. 140 is the high of 2018. That is what I would expect on NCC. But NCC and HG Infra look the best plays in infra at this point of time.
Let's get in some BTST trades as well going on there. By the way, our sources are indicating that Union Bank is going to review a QIP plan after their fourth quarter earnings. But Naresh, on your list.
So the two buys would be NTPC, which is a defensive bet here, and with a stop loss of 173 and a target price of 178. Second would be HDFC Bank with a stop loss at 1550 and a target price of 1600.
What about you? What's making it to your BTST or STBT list?
So as of now, BTST to buy calls. The first one is a buy in Navin Fluorine. Stock looking attractive above the 4,250 mark. So would suggest a buy with 4,400 as a target. Stop loss at 4150. And the second would be buy in ITC, a stock which we discussed just at the start of the show. Looks attractive. Targets of 400, which I would outline for ITC, even from current levels, and stop loss 365.
Right, okay. Those are some BTST trades coming your way. The Nifty, by the way, is going to close in at the lowest point of the session, nearly actually a 1% fall from the highs of the day, which was around that 17,205 print. We're going to close roughly just about defending that 17,050 market trade. Kunal, what's it telling you about the texture of the market right now? Are we going to continue sideways and drift lower once again back to, sub 17K levels? Or 16,800 as you put it, which is the most sacrosanct mark?
Yeah, absolutely. So I think what's been happening, Aisha, is that the range is shifting lower for the indices. Almost a month back, we were discussing about 17,200 and 17,800, or broadly 18,000 as the resistance for the index. So that was a 600 to 800 point range for the Nifty. Now after this sharp correction, and I think you were rightly pointing out that 17,200 becomes a very difficult resistance for the indices to break and cross over about those levels. So that remains to be a ceiling or a resistance for the index. And the floor, which is 16,800, where we bounced off twice in the last week, I think that remains to be a strong support. So the range is shifting lower, the range is narrowing towards 400 points, and it always makes sense to try and take an index kind of a trade only once we break out or break down below this trading range. So as of now, the view would be not to initiate any kind of a buy or a sell call over here for the indices, but only below those levels of 16,800 or above those levels of 17,200 is where I believe traders should look out for a sell or a buy trade respectively.
Yeah, so that's a take coming in as far as the market is concerned. But, Nuresh, a word on some of these top buzzers at this point of time. Spark, Aegis Logistics, Craftsman Automation. Would you look at buying any of these names if the momentum continues to be on the upside?
So, say Spark and Craftsman are more like a single day move. Aegis is the one which is an interesting chart. The stock has been in a higher top, higher bottom formation all through the last 1 year. The stock is very close to the highs it made last year around that 400 mark. Very recently, also in the last 2 months, it has made two tops around 390 to 400. So it's setting up for a bigger cup and handle breakout, and that would also be an all-time high for the stock. So clearly, this is a stock which is setting up nicely. We would expect some volatility here, but overall, if this move continues, I would expect it to be a 460 to 500 rupee target and a buy at current levels.
Okay, so that's a take coming in on some of these top buzzers as well. In fact, today we spoke with the management at Rustomjee as well, and they talked about the fact how there has been a impact coming in on the affordable segment of the rate hikes. Let's listen into what the management had to tell us.
Gudi Padwa, which happens to be an auspicious time for most people to go out there and buy new stuff or new homes, etc., was actually not the very best, but it wasn't very bad either, given that, rising home loan rates, etc., have played a dampener. But these dampeners have been more on the affordable and mid to mass housing. That's up to about 3.5 crores. We did not see a surge in buying, which is normally this is the season when we see that surge. We've got a huge pipeline coming up in terms of launches, more in areas where we are extremely strong. Given Andheri, given Bandra East, that entire belt is where we command great premiums, and we continue to be there. We also found that our foray into the eastern suburbs has been extremely successful, and thereby we are kind of taking on redevelopments in that market, and we believe that's a very strong market given the infrastructure growth. And Mumbai, very funnily or very from time earlier, there are these classes of people that want to live in one particular location. So Kandivali happens to be a very strong draw. We are looking at that market. Borivali as a segment itself and Andheri as a segment itself, again, have a very strong draw. Bandra East is seeing a lot of activity as of right now, and we continue to be one of the larger developers in that area. So we'll continue to launch projects out there.
Okay, let's see where the closing trades are actually headed. Pretty much around the session lows. 17,087 for the Nifty futures is how we're shutting shop. I think it's going to be imperative to see whether the global equity markets build on some more pressure or not. While right now, of course, the US futures seem like they're going to have a bit of a recovery in store for them, unlike the close that they had yesterday post the Fed meet. It's a smidge of a green. They too have come off from the top, I must admit. But let's see which way they actually head from there. European markets, though, they are the ones which are actually, after a quiet start, much like us, headed lower. So it's a 0.5% cut pretty much across the board, with FTSE underperforming, almost a 1% cut coming in for the FTSE index as we speak right now. For us as well, over a 1% fall from the top of the day, the Nifty Bank being the biggest drag, about a 1% cut coming in there. And barring BOB, all constituents of the Nifty Bank have managed a red close for themselves. Even Bandhan Bank, not BOB, Bandhan Bank, the sole winner there. Bandhan Bank also came off quite considerably and barely managed to close in the green, just a smidge or so. So Kotak, HDFC, IndusInd, ICICI Bank, Axis, SBI, BOB, RBL, they've all been a pack of losers. In fact, SBI has been the biggest drag also on the index, by the way, and I think the biggest contributor as well to the laggards today. Asian Paints, Kotak, Reliance has fallen another 1.5% today, Bajaj Auto, Infosys has been a laggard, so has IndusInd Bank been. These have all been stocks which have pressured the index, as was the case with the breadth of the market as well, which managed to close in the red. So it's been HAL, which closed 5.5% lower. Vedanta, again, 5.5% cut there too. Aditya Birla Fashions, Page Industries, these have all been laggards. Handful of winners as well in today's market. So Nestle ITC, Cipla, Maruti and Hindalco were some of the winners. Bharti also cooled off from the top, but 0.5% higher is where it shut shop. Coromandel, Balrampur Chini, Biocon, Manappuram and ABB were some of the star performers from within the broader end of the market. But that's it then on this edition of Closing Trades. Thank all of our experts for joining in today on the show. Let's see what the market holds in store for us tomorrow morning.